that one investing advice of Dave Ramsey really grinds my gears. Dave Ramsey advised everyone to invest in
a good growth stock mutual fund.
Mutual funds. Like many of you, my own mother invested in mutual funds for over a decade, only to break even. The truth is that mutual funds are designed to enrich fund managers and not individual investors like us. It's like running on the spot instead of walking towards financial freedom. By shifting to a more efficient strategy, my mother saw a 3,000 in gains with just 3 years by investing in index funds. Both mutual funds and index funds look on the surface the same. Both two buckets holding several companies within means with one purchase you can buy multiple companies. No need to pick the right winners and losers anymore, and analysis paralysis isn't an excuse for you anymore. But let me tell you something, there is a crucial difference that makes mutual funds an incredibly inefficient choice for individual investors. Mutual funds are actively managed, means put together by a mutual fund manager. That means someone needs to pay this manager for his knowledge and expertise. While these index funds are just mirroring the stock index, no work is required. My favorite example is the S&P 500 index, which tracks the performance of the 500 biggest US companies such as Apple, Microsoft, Nvidia, Tesla, Google, and so on. The S&P 500 is also the benchmark for all investors to beat. And here is the secret. Studies show that around 90% of all investors fail to beat this benchmark. It's extremely difficult to beat the market consistently. Yes, some mutual funds can beat the S&P 500, but over long term means more than 10 years, they all fail to do so. Warren Buffett, investing legend and my hero, had once a $1 million bet with a group of fund managers to beat the S&P 500 over 10 years. After 10 years, Sides, a mutual fund manager, wrote in a Bloomberg post, "For all intents and purposes, the game is over. I lost." And it wasn't even close. By Warren Buffett's passive choice, the S&P 500 had gained additional 854,000. Sides' choice gained 220,000. Yep. That's a difference of $500,000. Finding mutual funds that beat the S&P 500 is as rare as finding the next Tesla or Nvidia before they explode in value. While it's possible, Nobel Prize-winning economist Paul Samuelson said back in the 1970s that for most investors, it's simply not worthwhile to try beating index funds. But wait, that's not all. There's something Dave Ramsey is never speaking about. And the advisor who sold you the mutual fund? Neither. I also mentioned that mutual funds are actively managed and you have to pay the manager. So let's dive deeper into the cost to prove to you why Dave Ramsey's advice is so dangerous for your wealth. The index fund of my choice, the S&P 500 by Vanguard with the ticker VOO, has an expense ratio of 0.03%. That means for every $10,000 I pay $3 per year. Or if I had $1 million, I pay $300 per year. Not a bad deal. But let's look at the mutual funds to convince you completely. They usually charge a fee of 0.5% to 1.5% fee. What percent? Come on David, that's nothing. But is it though? Let's take the same numbers as previously to prove my point. If I gave a mutual fund manager my $10,000 regardless of the performance, very important point, regardless of the performance, and I pay a 1% fee just for routine operating costs and the fund manager's fees, I would pay $100 in fees per year, and we are not beating the boring index fund. And for $1 million, I had to pay him $10,000 compared to the $300 is outrageous. It's like investing with lead weight strapped to your portfolio. As you can see on this graph, in the beginning, the costs do not make a big difference in your portfolio, but over time, you can see the gap to low-cost index funds is getting bigger and bigger. The evidence is clear. For most individual investors, following Dave's outdated mutual fund advice could mean leaving tens of thousands, if not hundreds of thousands, on the table versus a smart low-cost index fund strategy. And if you want to know more about the S&P 500, I have the perfect video to watch next, where I talk more in depth about the S&P 500. See you there, investor.